In this video, we're going to do a general overview of how to measure the opportunity of your startup. So let's start with this. Why are we doing this? Well, it's incredibly important that you understand the opportunity so that you can have intelligent conversations with your investors. Maybe even more importantly than that, it will give you realistic expectations when developing your business plan and your sales projections, something far more solid than a best guess. But before we start, let's rewind the clock a little bit. In my last video, we talked about how to measure the value of your startup's valuation, even if the startup was pre-revenue. There's a lot of discussion about this on Facebook and Reddit, but the bottom line, if an investor is going to invest in your organization, you need to put a value on your startup, regardless of what stage you're in, even if you are pre-revenue. And remember, this exercise really isn't about what the company is worth right now. It's really just to start the conversation about how much equity an investor will get in exchange for their investment. That's the real end game here. So before we jump in, if you didn't get a chance to check out my last video, What's My Startup Worth? I'll put a link to that video at the end of this one. You should definitely check it out. Also, if you are a founder or an executive of a startup and this type of content resonates with you, please hit subscribe. It's a really big deal to me. It really helps the channel. It also makes sure that you don't miss videos in the future. I put out a new video every single Friday for people just like us. So that being said, there's really only one good way to measure your startup's opportunity. You need a financial plan that projects expected revenue. And if you're a pre-revenue, there's really only one way to do that, and that's by measuring your startup's opportunity in the market. How do we do that? Well, the way we do that is by determining the TAM, SAM, and SOM, or the total addressable market, the serviceable addressable market, and the serviceable obtainable market. If we can get an understanding of these three numbers, we can create a financial plan with goals around them that will really help us out with everything else. Now that we're on the same page with why this is important, let's get into the details. It all starts with calculating the TAM, SAM, and SOM. And if you're not familiar, TAM, SAM, and SOM, they're just acronyms for three metrics that help describe the market that your organization sits in. Total addressable market, serviceable addressable market, and serviceable obtainable market. I'm going to walk you through an example in a minute, but so you better understand these terms, let's talk about each one of them briefly. TAM, total addressable market. TAM refers to the total market demand for your product or your service. It's the maximum amount of revenue a business can generate by selling its product or services in a specific market. It represents the maximum market potential. SAM, the serviceable addressable market. Due to the limitations of your business model, maybe it's geography because you only sell in the United States, you're going to have a tough time servicing the total addressable market, so you need to come up with this number. The serviceable addressable market is most useful for businesses that are looking to objectively estimate the part of the market that they can acquire to help figure out their targets. SOM, serviceable obtainable market. Now, unless you're a monopoly, you're not going to capture 100% of your SAM. Even if you only had one competitor, it would still be extremely difficult to convince an entire market to only buy your product or service. That's why it's crucial to measure your SOM, or your serviceable obtainable market, to estimate how many customers would realistically benefit from buying your product or your service. Okay, so let's see a real world example. I just grabbed an example offline to walk us through, but I think this is a pretty good one. This is a company called Clove. Clove is a footwear company, and they specialize in comfortable sneakers for healthcare workers. They're based out of Philadelphia. The company sells through its e-commerce website, strategic partnerships, mostly with healthcare providers. This is what their TAM, SAM, SOM looks like. So firstly, their TAM, the total addressable market. As you can see here, it's about 360 billion. This represents the entire footwear industry globally. So any kind of shoe, any kind of market, all sales, all in, about $360 billion. The SAM, which is considerably smaller because they don't sell all kinds of shoes, nor do they sell in all kinds of markets, their SAM is much smaller and limited to only healthcare type shoes. Now, this market was limited to 8.1 billion. Lastly is the SOM. Of that market that they are focused on, what do they think they can actually obtain? The serviceable, obtainable market. In this particular case, it's actually, as a percentage, it's quite small. And I'm going to guess they've narrowed it down to a geography. Perhaps they only sell in certain countries. And they're also probably guessing that they're only going to capture a certain percentage of the market. I generally recommend that you go no higher than 1 to 5% market share. Anytime you get close to 10% or exceed 10%, investors are going to start asking questions, and they're definitely going to question your math. In this particular case, they've determined that their particular SOM is 1.8 million. So what they think they can acquire in the market is roughly 1.8 million. Now, for your startup, when you do this exercise and determine your SOM, or your serviceable obtainable market, it's going to give you a good number to back into for both your business plan and your financial projections. So there you have it, a quick overview of how to measure the opportunity of your startup. Follow this, and not only will you have a much more dialed in financial plan based off market data, you'll also earn the confidence of potential investors as you walk them through it. I hope this video gave you something to think about, and if you found it insightful, you should check out my ebook. I put a link to it in the description below. It covers the first 10 things I would address when helping an organization guide through or plan for a growth phase in their startup. Lastly, if you have any questions about what you heard in this video, I would love to hear about it in the comments below. Thanks again for watching.